Consumer sentiment, how folks are feeling about the economy, well, it seems to have taken a bit of a dip, actually reaching its lowest point since way back in November of 2022. It's a pretty noticeable shift from the kind of rosy outlook we saw after the elections wrapped up in December. The latest numbers coming out from the University of Michigan, they're showing significant drop, like an 11% decrease this month in how people are feeling about the economy, landing at 57.9. That's down from a more comfortable 64.7 just last month. So what's driving this wave of, well, let's call it economic apprehension. It seems a big part of this downturn is tied to anxieties really surrounding the current administration's approach to trade policies. We're seeing a direct link between those policy moves and a bit of an erosion in how confident consumers are feeling about the economic picture in the U.S. Think about the tariffs that were announced. Even though some were walked back after pushback from business leaders, it signaled a potential shift away from those long-standing trade agreements, and that can create a lot of uncertainty about what things will cost down the line, how stable our supply chains really are. And those are the things that hit people right where it matters, in their wallets, impacting their purchasing power, their sense of economic well-being. Let's rewind for a moment and look at how things unfolded. First, there were those tariffs introduced on countries like Mexico and Canada, and then came the U.S. tariffs, focusing on steel and aluminum, which almost immediately triggered retaliatory measures from both the European Union and Canada. These back-and-forth tariffs really highlight how interconnected global trade is these days, and how fast things can escalate when disputes arise. These trade actions, they don't just exist in the vacuum. They create what you might call a ripple effect that spreads throughout the entire economy. When the rules governing international trade become less predictable, it makes it incredibly tough for businesses to plan their investments or manage their supply chains with any real sense of certainty. Take, for example, a tariff slapped on imported steel that can directly increase costs for a company, say a U.S. car manufacturer, and that often gets passed down the line to the consumer in the form of higher prices for cars. This kind of widespread uncertainty just fuels a general sense of unease among consumers about where the economy is heading and whether it's really on solid footing. And this isn't just some vague sense of worry either, it's manifesting in very real ways, especially when you look at what people are expecting in terms of inflation. Right now, Americans are bracing themselves for an inflation rate of 4.9% over the next year, which is a substantial leap from the previous 4.3% and the highest we've seen since November 2022. It's also worth pointing out that this marks the third month in a row where we've witnessed a significant jump, at least half a percentage point or more, in what consumers are expecting prices to do. This rapid climb in inflation expectations brings up a really important question. What's the connection between these trade policies and the actual cost of living? You see, tariffs, by their very nature, have a tendency to inflate the cost of imported goods and thus inflated costs. Well, they often trickle down to the consumer, contributing to a general rise in inflation across the board. The fact that consumers are expecting prices to increase so dramatically suggests they're already factoring those potential price hikes into their household budgets. And that can have a real impact on how they feel about the economy overall. Joanne Su, she's the director of the University of Michigan Consumer Survey. She highlighted a really interesting point. She noted that this less optimistic view of the economy isn't limited to one side of the political aisle. It seems like everyone, Republicans, Democrats, Independents, they're all feeling like things have gotten a bit shaky since February. That kind of bipartisan agreement is pretty telling, don't you think? It's a pretty strong indicator that these concerns are just partisan responses to the policies being put forward by the current administration. It suggests there's a deeper, more fundamental sense of instability being felt across all sorts of different groups. These frequent shifts in economic policies, as Sue put it, they make it incredibly difficult for people to plan for their financial future. It doesn't matter what party you affiliate with. That kind of uncertainty is going to affect how you approach things like saving, investing, and even just your day-to-day spending habits. So as we look ahead, what could be the real-world consequences of this dip in consumer sentiment, particularly when it's fueled by these anxieties about trade wars and the specter of rising inflation? It seems like this is all happening at a pretty crucial moment for the U.S. economy. It really does. We're starting to see other signs popping up that suggest things might be slowing down a bit. For example, back in January, we saw the first decline in consumer spending in almost 2 years. And on top of that, there was a significant drop in home construction during that same period. Now, given that consumer spending is such a massive driver of economic growth in the U.S., any indication that it's weakening is a pretty big deal, something we definitely need to keep our eyes on. And it's not just numbers and statistics that are raising red flags. We're also getting some pretty cautious signals from some major players in retail and the travel industry. Companies like Target, Walmart, and even Delta Airlines, they've all said they believe consumers are starting to feel the pinch financially and might start tightening their belts as the year goes on. These are companies that have a really deep understanding of how consumers behave, so their assessments carry a lot of weight. To make things even more complicated, we have the real-time forecast from the Federal Reserve Bank of Atlanta. Their current model is actually predicting a pretty pretty substantial contraction of the economy, like 2.4% in this quarter. It's important to remember that this is just one projection, and things can change quickly in economics, but it does underscore the possibility that we might be headed for a more significant slowdown than some folks were anticipating. It does seem a bit paradoxical, doesn't it? On the one hand, the job market is still looking pretty strong. Unemployment is hovering near record lows, which is usually a good sign, right? But at the same time, we're seeing this declining consumer sentiment, the potential for people to start spending less, and the possibility of an overall economic contraction. How do we make sense of those seemingly contradictory signals? It's the exact mix of factors that's causing concerns about the possibility of stagflation. Essentially, it's the risk that economic growth could slow down dramatically, maybe even tip into a recession, while at the same time, short-term inflation expectations are on the rise, largely driven by those tariffs we were talking about. It's a tricky situation for policymakers to navigate because they're dealing with these opposing economic forces. And for the average person, what does stagflation actually mean for their daily life? Well, it could mean fewer jobs are being created, and the ones that are available might not pay as well. And on top of that, the prices of everyday things like groceries, gas, and clothes keep going up. So where does that leave the Federal Reserve? They're in a tough spot, having to carefully weigh all these conflicting economic signals as they get ready for their upcoming policy meeting. Federal Reserve Chair Jerome Powell has acknowledged just how complex the situation is, saying that how they respond will depend on a thorough assessment of how different policy changes are impacting the economy as a whole. He didn't just focus on tariffs either. He also mentioned things like immigration policies and federal worker layoffs as additional factors they'll be considering. What Powell is saying really highlights the intricate connections between different policy areas and how they can all combine to affect the economy. It's not just about the isolated impact of tariffs, it's about how those trade policies interact with other government actions and how that ultimately shapes consumer behavior and the decisions businesses make about investing. The Federal Reserve's job is to figure out the net effect of all these moving parts so they can set the right course for monetary policy. And that's no easy feat. This whole situation really drives home the point that global trade, consumer confidence, and the health of the U.S. economy are deeply intertwined. The next 2 months are going to be crucial. We need to pay close attention to see how these policies play out in the real world and what their lasting effects will be. Speaking of real-world effects, for anyone listening, let's talk about what these rising inflation expectations could mean for your day-to-day life. They could mean that the money you have simply doesn't buy as much as it used to, making it harder to afford those essential things you need. It's a sobering thought, and it brings us to a final question for you to consider. Think about how quickly consumer sentiment can change, how sensitive it is to shifts in policy and economic uncertainty. What does that tell us about how fragile economic confidence could be and how important it is to have stable, predictable policies in place? It's definitely something worth pondering. And hey, if you found this deep dive into consumer sentiment and trade policy interesting and informative, we'd really appreciate it if you'd take a moment to like and subscribe to our channel. It helps us keep doing what we do. We'll be back soon with more in-depth explorations of the forces shaping our world. But for now, thank you for joining us for this deep dive. We look forward to having you with us next time.